All right, so a quick recap on the market. So what happened was basically the market went up here. You see and there's a couple of things I wanted to share before I go off on a tangent. First is reading wave volume. This is really important because when volume, there's a couple of key things, at least from a Wyckoff perspective. Volume is good for climaxes. That's what volume is predominantly used for, to identify climaxes. Whether it's effort reward or whatever, just call it like high sudden volume that's, high at the top or the bottom of a trend, right? So this is why it's important, because it's telling you that basically there's smart money there, right? So, it's telling you get ready to enter, get ready to exit, all of that. All right, so that's important. And the second thing is pressure. All right, so now with that in mind, how do you read it? All right, so there's two very obvious ways. All right, but most folks will only use one, and that is they compare the up wave to the down wave. The rally, the pullback, the rally, the pullback, the rally, the low volume pullback. Yes, this is a valid way, but you're forgetting the other way, and that is to compare demand with prior demand. So the 6 to the 4 here, then the 11. So you're also doing this. So you're comparing the up wave to the up waves, the down waves to the down waves, and the up waves to the down waves. So what does that mean? It means you're comparing demand to itself to see if it increased or decreased. All right, so that's when you compare up wave to up wave or prior up waves, all you're really doing is seeing, is the demand still there? Is it weakening? Is it more? Is it increasing or decreasing? When you're comparing down wave to down wave, what you're doing is comparing to see if supply is increasing or not. All right. So the first thing you want to do is compare the up waves to themselves and the down waves to themselves, and that's the second thing. And then finally, the third thing is the up wave to the down wave. So this is the error that most folks do, is they will only focus on the biggest volume, or they don't pay attention. And this is the problem, because you have to read the volume as it's occurring. So they'll just wait, and if it's something steps out or like really is unusual volume, they'll just focus on that. But that's the error, because you have to see the trend of the volume. You have to see the trend of the volume to see if there's a change in the amount of demand and supply. So for example, what I would do right here, very obvious, I was doing this morning, I saw this as 9 and I saw this as 11. Immediate red flag. Why? 9 caused this big wave. Now ask yourself this question: is this 11 here more or less than 9? Obviously it's more than 9, but look at the amount of progress you make. It's much less. So look at, what did you get for this 9 volume, which stands for like, I think 90,000 shares, whatever. So for 90,000 shares, you get all of this, and for 110,000 shares, you get a little more than half. So why is it that there's so much effort, but not the same or more amount of reward? And that's because they're selling up here. There's pressure, there's resistance up there. So this is the way you're reading it. You would not be able to read this if you only compared the rally to the pullback. If you only compared the 11 to 6, what would you think? You say, oh, 11 is good, 6 is weak, 11 is strong, 6 is weak, right? So yeah, we're bullish, but that's incorrect. The reason is you haven't compared the upwave to the prior upwave. And when you do compare the upwave to the prior upwave, it isn't only an increase in pressure, but also the distance of the wave. Because what you're asking is, what did you get for it? What did you get for this buying pressure? This, 110,000 shares, but what did you get for it in terms of price movement? Not a lot. Same thing here with the 90,000 shares. What did you get for it? You got this big wave. Over here, 110,000, but little wave. Why? That's the question. So this is the difference between, no, this is just the what should I say? This is the way to read wave volume. You are first and foremost, and let me write this down. You are comparing demand to demand. Demand to demand is the upwave to the upwave. In this case, it's the 9 to the 11. Then you're also comparing supply to supply. Then you're comparing the demand to the supply. So what does this mean? It means demand, you're comparing demand to demand, means you're comparing the wave, upwave volume to the prior upwave volumes, the 11 to the 9. Supply to supply is the 3 to the 6. And what do you see when you compare supply to supply? What do you see? 3, 6. It doubled. You see? It doubled. Okay? So there's an issue. And then finally, as you're comparing, you compare what did the market get for it, get for the volume. What did the bulls or what did the bears get for the volume? For 11, they didn't get a lot, right? They didn't get a lot. They didn't get a lot of price movement. Why? Because it's encountering resistance. All right. So you're comparing demand to demand, supply to supply, demand to supply, and asking when you're comparing demand to demand, you're asking, actually it's two questions. I didn't want to get into all the details, but when you're comparing demand to demand, one of the things is it increasing or decreasing? Right? When you compare demand to demand or supply to supply, the question is it increasing? Is demand increasing or decreasing? Then you also ask, what did the market get for the volume? Same thing when you're comparing supply to supply. And then finally, you compare demand to supply and just see, is it bullish or bearish? So this is the problem. Folks don't know how to read the wave volume, so they'll just look for big volume. That's it. Just big volume, like a big green bar, that type of thing. So that what else is there? Yeah, and one way of asking what did the market get for the volume is actually there's two ways. First is the distance of the wave. You see for 110,000 shares, which is 11 divided, so you don't get a lot, right? So that the entire length of the wave, what did you get for it? You got a smaller wave than the prior wave. That's one. And two is the amount of thrust from high to high or low to low. So for example, for you would see, okay, for 8 you got this much, for 6 you got this much. What else? What is the thrust? See, this is good thrust from low to low, right? So that's the thing. You want to see, compare demand to demand, supply to supply, then demand to supply, which is nothing more than comparing the up wave to the prior up waves, down waves to the prior down waves, and then comparing the up wave to the down wave. Always asking, you know, is pressure increasing or decreasing? And what did we get for it? All right. That is a, I think that's all you really, I mean, that's the foundation right there. That what I just explained is the foundation. I'm going to delete this. So now let's go over it. So we're just going to see demand. So you see, let's just start here, because when the morning open, you know, it's pointless using that volume because just a rush of orders. All right, so you have 9. Then you have 11. It's increasing here, but are you getting a lot of price distance? No, you're not already. So this is making you think, something's not right. All right, next. Okay, so it increased here, now went down to 4, right? And believe me, you won't be able to understand every wave. That's fine. You know, you're looking, okay, oh, all right, it went from 9, got some resistance up here because of the increased volume, a lot of effort, almost double, not double, but an increase, but not a lot of price movement. Then after that, it totally dipped right here. Went 11 to 4. That's almost a third. Like, oh, shit. Okay. Now, you have slightly increasing volume, but it looks like an upthrust, right? So over here, you don't really know what's going on. If you're reading volume, you don't know what the hell is going on here. So the only clue is over here. The rest, I would say, is like, I'm not going to concern myself too much with it. If it's not easy to read, it's not easy to read, right? Here, there's a different concept called a little bit of ease of movement, and I don't want to get into that too much, but we'll talk about that later. So finally, so what is the tip-off? The tip-off is this effort. This is effort right here. A lot of juice, but not a lot of reward. And oh boy. And probably this little dip over here from 11 to 4. You don't know what's going on. It tries to increase, could not hold, goes down. Something is fishy. And all of this at a resistance level. I mean, mind you, this is all at a resistance level. All right. So you know something's not right here. And then eventually breaks. So you get the break right there. This right here means that 21 stocks participated in, let's see. So right here, 9 stocks, then 7, not that much. Tries to go up on 5 upticking, and 21 downticked. That's the biggest in 1, 2, 3, 4, 5, 6. About 10 bricks, 10 candles. Something's really off here. And that basically did the break. And then after that, what happens? Okay. Increase. After that, what happens? Increase. 21 stocks downtick, then 38 stocks downtick, then 59 stocks downtick. What is this? Liquidation. This is liquidation right here. Selling. Liquidation. It has to be liquidation. Sell. You know, and then it takes a little break with only 38. Then over here, 27. So it's still, you know, it's not sure. But then liquidation resumes. Where does it resume? Liquidation resumes here, here. These two are very clear that liquidation is resuming because it goes from 27 to 57 to 67, increasing. You have only 53, but then it resumes again, 63. Here tries to bounce, and what happens? 147, boom, down. Then 135 stocks, boom, down. Down. I'm not impressed by this 44 because over here you have 47s and 57s. But I am impressed with this 118 right here. You see this final up wave here, 94, 43, 66. Okay, and then 118, break the market. Liquidate, liquidate, hold off on the liquidation, and then start to bounce. So, what's the point? The point is, learn how to read wave volume the right way, and it's really simple. One is comparing demand to demand to see if demand is increasing or decreasing. The other is supply to supply to see if supply is increasing or decreasing. And then demand to supply, which is basically the up wave to the down wave, to do a relative strength comparison. And then finally, when you are comparing the demand to demand or the supply to supply, you want to see what you got for the volume. What was the result of all of that pressure? What the buyers, what were they able to do? Were they able to do anything? If not, then forget it. There's a problem. That means there's a lot of effort, no reward. Why? Because there are orders there that are absorbing the buying. The sell orders it's hard to get through them. All right, long story short, have a good weekend. Oh, and here's a nice example of where you can see this bounce. Look at the 7. This is an example of comparing demand to demand to see the weakness, okay? So you have that 7. Okay, so there's a 7, right? Is it increasing? Yes, it's increasing from the prior demand, which is 5. So 5 to 7 is an increase, but after that it dips. Uh-oh. So you go from, and remember this is a pullback, right? It's all a pullback. So 7, then 4, dipping, and dipped to only 2. When you're comparing the demand, you see it dips from 7 to 4 to 2, weakening demand. And what is happening with supply? First, it was weak, it was only 1. Then it increased to 2. Then it increased to 7. What is that a clear indication of? It's an indication of the strengthening of supply and the weakening of demand. Is it no wonder that this market is going to continue to go down? You see, you're comparing 7, 4, 2, weakening, decreasing pressure, 1, 2, 7, increasing supply pressure. Market breaks. Done. I hopefully you learned something. If you want to follow up on this, you can go and actually it would probably be watching the Big Mike webinars with wave volume would help explain this. All right, take care. Bye.